So we were doing decision-making techniques, and now within decision-making, we come to a point where we talk about short-term decision-making. What does that actually refer to? Short-term decision-making, like, when you take some decisions under some very special needs in some very special cases, they are not, how to say, these decisions are not sustainable for the long term financially, but you may agree to take them on the short term basis. Like in your personal life as well, it has happened. Business also, it happens. For example, I'll just give you an example. Usually I sell something for $10, and it is possible that for some time period, I may say, okay, I'm selling it for 9. This is only for this particular short period. It's not my long-term strategy, but this is, at this point in time, I can do it. So this is what you call short-term decision making. And of course, we are talking about the financial side of the decisions. And the topic we are going to discuss today, that is called relevant cost. So when you take short-term decisions, you always think about the relevant cost. We did this thing in F2 as well. We'll make a quick revision, and then we move forward to F5 level. Relevant cost, they say that these are future cash flows arising as a direct consequence of a decision. If you ask me what is relevant cost, I mean, technically I can explain you many things, but to put it in very simple terms, if somebody says what is relevant cost, the best definition which I can give you, I would say that, a relevant cost is a cost which is relevant. It's that simple. I mean, which is relevant, which means you take a decision and that cost you incur. I mean, any cost which you incur after taking the decision, and it has to be cash or opportunity. Two things, either it is cash or it is opportunity cost. So we say that relevant costs are future costs. So any past cost is not relevant cost. Past costs are not relevant. Future, they have to be like you take decision now, today, and after taking decision, what will happen? And they must be cash flows. So it means that depreciation is not relevant. Any other non-cash things are not relevant, and they have to be incremental. Incremental means additional. So relevant costs are also differential costs and opportunity costs. So differential means any change, incremental, which you call, okay? Incremental, the word you call differential. And they could be opportunity cost. We know what is an opportunity cost. We will discuss the example. We say that it is, the next best alternative, or the next best alternative foregone. Let's call like this. It's the next best alternative foregone. For example, if the very simple example of opportunity cost, I tell you, if any of you have studied economics, I remember, because when I studied economics first time, we also came across this word opportunity cost first time. And I'll give you an example, like, very simple example first I'll start with. So it said that, I remember exactly, and it is very interesting that when I was doing I started this bachelor's, it was 1989. Okay, let me speak a little bit. And what is interesting, I will tell you. And at that time, there were no Google, there was no PDF, there were no YouTube, no internet. The only thing is that you have access to the books which are available in the market, and they were very few in numbers. And would you trust that? In 1989, so I was studying in Pakistan in one university, and the economics book, which everybody used to say, okay, go buy this book, go find this book. And that was an Indian author's book. His name was Shukla and Gupta. There were two books, Shukla and Gupta. I'm talking about 1989. It is 30 years ago. And that still is in my mind, because because there were not 1,000, authors. There were only 2 or 3, and everybody used to say, go buy Gupta's book, go buy Shukla's book. And these books were not commonly available. We used to buy them from old bookshops. Okay, we used to go, do you have Gupta's book? They say no, because students, they used to sell, come next week. Do you have Shukla's book? Okay, come next week. Anyways, Gupta and Shukla's book. This was my first interaction with economics in 1989 with Indian authors because their books were really good. And now I'm telling you the example from there. Okay, I'll go back to that 30 years ago. What I first time where I started learning opportunity cost. So it said that imagine that you've got only $1 because we say that economics is like the subject of scarcity of resources. We have talked about limiting factor constraints because we never have unlimited resources. We always have limited resources, and that's why we did linear programming. That's why we did contribution per hour. We did throughput accounting. We made our priorities. So we have been focusing on limited resources. So let's suppose you've got only $1, and there is, if you want to buy Coca-Cola, it is a can of Coca-Cola is $1 and a hamburger is $1. This is exactly the example which was given in Shukla's book, which I read in 1989. No exaggeration. And it said $1 for Coca-Cola or a can of Coke, or $1 for a burger, a hamburger. What you do? You can buy one of them. So if you are hungry, you would buy the burger. If you are thirsty, you would buy Coca-Cola. So because I am thirsty, I decided to purchase Coca-Cola. So I gave $1 and I got Coca-Cola. So the economic cost of Coca-Cola is $1, but the opportunity cost is hamburger. I can say that I got this Coke at the cost of the burger. I mean, I left the burger. I said, next best alternative foregone. What you lose, what you leave, what you just left to achieve something. That is called opportunity cost. So I would say that the cost of getting a Coca-Cola is the burger. So a burger cost me to get this Coca-Cola, So opportunity costs are also relevant costs. Differential cost is the difference in total cost. Differential means, incremental, it means additional. An opportunity cost is the value of the benefit sacrificed when one course of action is chosen in preference to an alternative. So what you sacrifice, that is your opportunity cost. A very important concept. We will use it in F5 and it will be very extensively used in F9 also. So we say that, we move forward, we say that relevant cost when making short-term, and it says only short-term decisions, consider only relevant cost, okay? And if you pay attention, it very strictly says that only short-term decisions. You take only relevant costs. You do have some other costs. I mean, relevant costs are not the only cost. I may have, if I think like I may have, for example, 10 different types of costs. But in short term, I can only take my relevant cost, okay? And I can ignore others. These ones I can ignore, and I will take only these ones. But of course, in long term, you cannot ignore these ones. This is just, I'm ignoring it now in the short term. But in the long term, of course, I have to include everything. But in short term, you can go with the only relevant cost. Include only incremental cash flows. Incremental cash flows means that if I take a decision now, I say, yes, I'm doing it, then what it will cost me. So what revenue will incur, and what revenue will occur, and what cost will be incurred. So for example, you make furniture, you make tables. A customer comes in and says that, please make one table for me. So if you say, okay, yes, I'm making a table for you, after saying yes to this customer, what you will get and what you will pay. I mean, your fixed cost, you were paying rent, but rent is not a relevant cost because rent you do not pay as a result of taking this decision. Rent, in any case, you had to pay. Your staff fixed salaries are not relevant because you were already paying them. Whether you take this order or not, you have to pay the fixed salaries of staff. But yes, the worker who will actually make the table, you have to pay him for 2 hours. So if you say yes to the customer, you have to pay 2 hours labor. That is relevant. Material you have to buy, that is relevant. Depreciation is not relevant because number one, you already had to pay it, and number two, it is not cash. So in relevant cost, we only talk about incremental cost. We talk about opportunity costs. And it is possible that fixed cost may also included. Usually fixed costs are not included, but sometimes you include if it is incremental, which means that if as a result of taking decision, if your incremental cost, if your fixed cost increase, only then you can add. So we come forward, we say that what is a relevant cost? These are future incremental cash flows. Very simple, future incremental cash flows. Only future costs are affected as a direct result of this decision, and they have to be in cash. Now we do one example. Let's see one example together. It says that, for example, you need 500 kilogram of material for new project. You've got 300 kilogram. You've got 300 kilogram of material already there, and which you purchased at $3. Current purchase price is 5 kilograms, $5 per kilogram, and scrap value is $1 per kilogram. So what is the relevant cost of 500 kilograms? So you need 500 kilogram. Now there could be different options. You know, I need 500 kilograms. What you have here, you've got here option one. Your option one is that you've got 300 in stock, which you purchased at $3. So that makes me 900. And then because I need 500, so you need to buy 200 from the market, and the current market price is $5. So you call it $5 and it makes you 1,000, and your total cost is 1,900. This is your option one. Then you've got option two. Option two is that 300, which you already have in your stock, you can sell it out as scrap, like that's the throwaway price. So when I multiplied here with 3, that was my cost. But what I can do, I am just seeing if I throw it out, if I just scrap it out, it would be $1. And you multiply this, it makes 300. But the remaining 200, you still need to buy from the market, and that would be $5. Because there is no other option. So it is 1,000, and your total cost becomes 1,300. And your option three is that this 300, which you already have in your stock, you consider it at the market price. So it's okay, I'm not throwing it. Let's suppose I have to buy it from market. So that is $5. And you know, you call it 1,500.
Sir, sorry to interrupt you. In
Yeah.
option 2, if we will scrap out over 300 kg, then we need to buy 500 or 200.
We will see that. We will see that. This is where we want to go.
Okay.
So now I've got three options. If you pay attention, that this 1,000 is same in all of these options. Okay, this 1,000 does not change, because 200 I have to buy, 200 I have to purchase, and that I will purchase at the market price. So it is same in all cases. The problem is with this existing material. Should I take it at 900, which means my cost price? Or should I take it the scrap value, making it 300? Or should I take it at $5, which is the current market price, and make it 1,500? I mean, these are the three where you make difference. Now you should remember that this one cannot be your answer. Okay, let me say like this. This one cannot be your answer, because past costs are not relevant cost. You should remember, relevant cost cannot be past cost. So this $3 was past. This is something which I purchased. That's gone. You just forget about it. Now, either you take this one or you take this one. And here in exam also, they will tell you in very straight language, or in real life, you know, you say that regular material. If it is regular material, take market price. No other use, take scrap value. This is the rule. For example, if in question they tell you that this is a regular material, so if it is a regular material, it means that if I am taking 200 kilograms from, if I take this 300 from my store, then I have to replace it. And when I would replace it, I would replace it with $5. So if you are using it regularly, I mean, if it is your regular material, if it is your regular material, if it is your regular material, then you should take this one, $5, okay, for regular material. Because if you use it from the store, you have to replace it, and replacing cost would be $5. So if I use this material regularly, I would take everything at this one, I call this one. But if it says that no other use, no other use means that if I'm not using in this project, what else I can do? Here the concept of opportunity cost will come in. I could only sell it for $1. Then you take here, no other use, no use, you take this one, okay? This scrap price. So scrap price you only use if it is not a regular material. If it is a regular material, you take the market price. This is the basic concept of this. Now, before I move forward, I just want to create one example, and I'll need answer from you people. I mean, there is some understanding which I want to give. Imagine that you have a worker whom you pay $50 per day. So your understanding with this staff is that you pay him, $50 per day. Every day he comes in at 6 o'clock, he knocks your door, you give him $50 and he goes home. Now, one particular day, it's already 2 o'clock and there is no work for this person. He's just sitting there idle. And you know that at 6 o'clock, he will come in and ask $50. And you don't have any task for him. He's just sitting there. And suddenly one customer comes in and the customer needs some job and the customer is, willing to pay $30. Customer is willing to pay $30. Now, what should you do? And you know that this particular worker can deliver this job. This particular staff can do this job. But the issue is that you have to give $50 to him while the customer is only willing to pay $30. What should you do? Should you say, or would you say yes or no to the customer? Okay, so how would I say? I would say that for this particular job, revenue is $30. Cost, I would say 0, because this worker cost is not relevant in this decision, because I'm not paying $30, $50 to him because of this job. This $50 I had to give in any case. So for this particular job, I would say cost is 0, and it will say claim $30 profit. Like, I know that you made a $20 loss today. I know that you paid $50 to the worker and 30 you got, so you are in net loss. That I agree. But the thing is that for this particular job, you made a profit of $30. Overall, you have a loss. So you need to understand that what is the cost relevant to which decision. If I say this decision, this particular decision, actually it gave me a $30 profit. Now I've got my some other losses from somewhere else. That's a different story. So this is the concept of relevant cost of labor. Now,
Excuse me, sir. Excuse me.
Yes, please.
Excuse me, sir.
Please.
Sorry to interrupt. But like the customer, this will be considered a separate job from the labor which we are paying.
No, this is the same person who is doing this job. I said that the same guy whom I have to give $50, he can do this job.
Okay.
I mean, I'm not paying anything extra.
Like the customer willing to pay that $30. I'm just asking that the same particular worker will do the same job,
right?
And the customer will pay $30.
Right.
Okay, so that's why we are earning like a profit of $30
from this job.
From this job particularly.
Overall, in a day, you made a loss. In one day, you made a $20 loss.
Otherwise, he would.
Because he gave 30, you already paid 50. So your company is in loss, but this particular job is in profit. Based on relevant cost principle. Because when you say this customer, your staff, or when you accepted this customer order, you did not have to pay anything extra. You never spent anything more. This 50 you already had to pay before as well. So this 50 was your committed cost. This 50 or your fixed cost, you had to pay it. It's not relevant. So we say that in relevant costing, we say the cash flows which are impacted by taking a decision. So the cash which comes in is 30 and the cash which goes out is 0. Based on my relevant costing, I would say my profit is 30.
Okay.
Okay, so we move forward. Okay, I said this $3 is relevant. Relevant cost of, so decisions affect the future, but cannot change what has already happened. Decision making should therefore look at the future consequences of a decision. Decision should consider what can be changed in the future. They should not be influenced by what will happen in the future that is unavoidable. Unavoidable means any fixed cost which you already have committed. Economic or financial decisions should be based on future cash flows, not future accounting measurement of cost of profit. So you should also understand that we talk about future cash flows. And this is what we do in your paper F9, investment appraisal and everything. Because future economic financial decisions, cash is an important thing which we consider. Accounting conventions such as the accrual concepts of accounting and the depreciation of non-current assets do not reflect economic reality. Cash flows, on the other hand, do reflect the economic reality of decisions, okay? So as a result of taking a decision, do you get some cash or not? This is what we talk about. And last point, managers should therefore consider the effect that their decisions will have on future cash flows, not reported accounting profits. And of course, in F2, F5, and P5, we don't talk about your IFRS profits. We talk about cash flows. Marginal costing might be used for decision making. For example, marginal costing is used for limiting factor analysis and linear programming. We just did that topic. It is appropriate to use marginal costing for decision making when it can be assumed that future fixed cost will be the same. Yes, but if future fixed cost will change, so the change in fixed cost will be called incremental fixed cost, and that you should also consider. But if the fixed cost do not change, then you can just ignore. And that all variable costs represent future cash flows. Yes, variable costs are my future. I have to buy material, that's a variable cost. I have to pay more for labor for making one more table, that's a variable cost, and that I should consider. So relevant costs are future cost, cash flows, incremental, but they may also be opportunity cost. Like we said that opportunity cost is also a relevant cost. We exclude depreciation. It's a non-cash thing. Sunk cost, it is past cost. Unavoidable cost, it is my committed cost. I have to pay it. So it's not relevant. Apportioned fixed cost. Like apportioned fixed cost means that, you've got some office premises. You already are paying $1,000 your overheads per month. You are paying $1,000 per head overhead. And then what happens that you start some small little project here. You are making a little small project and you think that, some part of this 1,000, maybe I should charge to this project. It happens very frequently. You say, okay, let's charge out of this 1,000. So 900 should remain here and 100 I should take to this new project, not allowed. A portion fixed cost you do not do. Yes, it is possible that if my fixed cost, they increase from 1,000 to 1,100 because of this project, then this 100 I can take here. If there is an increase in the cost, if the fixed cost or if your existing overheads do not change, then you don't take them. It's not relevant. And finance cash flows, interest is always not relevant. You should remember. So these are your relevant costs. Sunk costs are not relevant. Committed costs are not relevant. Apportioned costs are not relevant. So we talk about relevant cost of material. If it is in stock, like in our example, 300 kilograms, and it is not in stock. If it is in stock, in continual use, which means regular. You take the market price, no other use or scarce. Three options. You have got in stock, either you use it regularly. If you use it regularly, then you should take the full market price. You take it like it says that, if taken from the stock, you will have to replace. So you take the market value, take market price, okay? But if it is no other use, like if you take it from the stock, you don't have to replace it, then you take the scrap price, like we took $1. If it is scarce, that actually needs calculation, and this is what it comes in exam. Scarce means that if taken from stock, you cannot replace it. Relevant cost is the opportunity cost. Opportunity cost, what you lose. Like, I tell you one thing. For example, I keep it very simple, just for understanding. We'll make it later difficult. You have a material which cost you, the cost of the material is, $5 per kilogram. And now I say that it is scarce. Scarce means that if I take it from my stock, I cannot buy and bring it back. It's not available anymore. And it is used, or it can be used in making some product which gives you $15 contribution. So I can use this material 1 kilogram to make some particular product, and that product gives me $15 contribution. So now my relevant cost per kilogram is equal to $15. It's $15. Relevant cost is opportunity cost, because if I take it from the warehouse and I give it to someone, or you come in and and you say that, can you give me this 1 kilogram of material? I know that I bought it for 5, but I would give it to you for 15. Because if I give it to you, I will lose this contribution. I will not be able to earn this thing. This material can give me, twice of that. I would say, you give me $15. You say, its cost was only 5. Why do you ask me 15? Answer is that, see, if I give it to you, I cannot make that product, which would have given me 15. So that's my cost, opportunity cost. It is possible. It can be used in making see here what I'm saying, 2 units of some product, because in 1 unit I use half kilo. So with 1 kilogram I can make 2 units, which gives you $15 contribution per unit. Now my relevant cost will be 15 times 2, $30, because that one particular 1 kilogram, I can use it in making 2 units where each would give me 15. So that's 1 kilogram of unit. I would be, asking $30 for that. So this is where you talk about the opportunity cost. So with material, you have, if it is in stock. So if you have a material which is not in stock, then it's very simple. You just have to buy it and you take the purchase price. But if it is already available in stock, then you have 3 options: continual use, no other use, scarce. In continual use, take market price. No other use, take scrap value. Scarce, you take opportunity cost. And this is where a little bit of confusion may come in, because when you will have to calculate the opportunity cost, you need to do something like this. You need to calculate, how much it could have, would have, or should have given you. Okay, so I move forward. Relevant cost of labor. With labor, you've got 3 situations. Either you could hire more labor, or you have a spare capacity, or you have full capacity. Okay, first let me speak full capacity. Full capacity means that I do not have people and I also cannot hire them. You don't have and you cannot bring in. How do I see full capacity? Full capacity means that no labor available and also can't hire. That's called full capacity. And here you go opportunity cost. If you have spare capacity means that your people are sitting idle. Just like you remember, $50 I was giving to someone, that was my spare capacity. Could hire more means that I don't have people, but I can hire them. I can hire them. So if I talk about the first one, could hire more, relevant cost is current rate of pay, because I will hire them from the market, and whatever market rate, it will apply. If it is idle capacity, if it is spare capacity, somebody is sitting idle, relevant cost is nil. And if it is full capacity, which means that I don't have it, and I and I also cannot hire it, use the opportunity cost. Let's do one example with full capacity. Okay, let's do one example. Labor is currently working on product A, and this is what you get. Your product A, it gives you sales revenue of 50, materials you use $3, labor you spend 1 hour, and which is $5, and your contribution is 42. What do we lose if we take the labor away to work on new product B? So here I need your contribution. Please give me answer. Think about it and give me answer. So what we lose here, you lose the revenue. Straight away 50 will not come to you, because you don't make the table, you don't give it to the customer, and the customer doesn't give you 50. But then you make some saving. You save you save your materials. You took out the labor from this scenario and you save on materials. So your answer is 47. You save one labor hour, because this person I just take out. If I take him away from here, I'm just taking him away. He's not working anymore on this job. He's working somewhere else. From this particular job, I lose 47. Sometimes students, they understand with this format. There is an alternative way of doing it, which I like more. I don't like this presentation. Let me show you an alternative calculation. I lose my contribution, which is 42. That's where you started before, Karthik, 42. But then, I think Harleen said that. But then what would happen? You add back labor, because you saved labor. You sent labor somewhere else. So you always think like lost contribution plus labor, lost contribution plus labor, because from this 42, material has already been adjusted. Okay, material you already have given out. You add back labor. 47 is lost to the business. This is something which you definitely will be needing in your F5 thing. The opportunity cost of labor. Always remember this thing. If you remember this structure, always say what is the lost contribution and add back labor to it. You will get your opportunity cost of labor. Okay, so this is the relevant cost of labor in this case. Any question until here?